Good evening, all. Ira Epstein with your financial market wrap-up, and what a day today was. And this is for Thursday, the 9th of June, 2022, 6:55 p.m. They're about to start the hearings on the January 6th incursion to the Congress, and we'll see just what that's going to mean. I don't know what they're trying to prove one way or the other than, I guess, still going after Donald Trump. If this backfires with elections around the corner, who knows? Do I think it'll be able to get him? You can't impeach him. Can you get criminal action against him? I seriously doubt it. But, got to see what the news says. Am I going to watch it? I am. So, gives you an idea. All right. Huge break in the market today. What caused it is going to be discussed for a while. I saw the market hold on, okay, when the European Central Bank at 7:30 in the morning told us that they are embarking on now a period where they're going to be raising interest rates, getting away from the zero policy. They didn't follow the Fed's pattern. The Fed is also running off its balance sheet. They are not at the European Central Bank. They're going to continue to reinvest, but they won't buy new bonds. Next, what they'll be doing is a quarter-point hike, not a 50-point hike. According to Ms. Lagarde, it was unanimous decision, but they probably got from her the idea because she said that come September's meeting, which is the meeting after the July when they're going to raise the interest rates, what will happen then is it could go 50 points depending on market conditions. So I am sure she did what she does great. She got everybody in a room, she talks facts, she's quite good at it, and got a consensus as to what should be. All right, was that enough to break today's stock market? No. But what I think can break the market is the fear of what the CPI number in the morning might show. The headline is going to be supposedly an 8.2% headline number. That's going to be a tenth, possibly less than the last report. What if it comes out 8.5, 9? I don't know what it's going to do. So you got to be a bit cautious here. Anything can happen with this, and maybe that is what spooked the market. Regardless, it got spooked and a lot happened. And this is what bear markets do. You labor on the rallies, and those rallies, by the way, can be rough. I was listening to people today talking about being short in a bear market and how you got to be careful you get run over because it can go anywhere to the upside, but if you buy stock, it can only go to zero. I have heard nonsense in my life, and that's the biggest crock of you-know-what there is. They're right on what they're saying. But the stock isn't going to go to zero. That's number one on that one day. And it's not going to go to infinity either. But that is exactly how people scare you. And they try to talk you away from being bearish the market. There's other ways to be bearish. You can play inverted spiders. They're there. There's many ways you can play. It's total nonsense, this idea of being short the market is bad for your health. I don't buy it. I've been in commodities since '69. I have seen as much danger on the long side in my long career as on the upside. That's all I can tell you. It goes both ways. All right. When we look at the S&P, is there any doubt in your mind you're still in a bear market? If not, I don't know what you think a bear market is, but you have to go define it for yourself. Is this, and I don't know that it is this the resolution of the sideways action? It could be. If you can't get over these numbers real soon, you open the door up for maybe a test of 3,800 as a chartist. When I look at the pattern on the swing line, lower highs, lower lows is bearish. When I look at where support is, it's the 18-day average, and you got under it, no question. So you're back in a bear trend. The risk in being short is back up to 41.59. Let's call it 41.60. You'd have to be over that number. What about downside targets? It could be, again, the Bollinger Band is matching up with this 3,800. So here's what I see so far. Trend down. The bias is down because you're under the 18-day average. A potential target, 38.65. The stop, if you want to be short, is far away, too far for the average person. That is 41.60. And the slow stochastics have turned down. The bears have control. How long they'll keep it, I don't know. What I will also say is this rally has run its course. That I will say with definitive Answer. Even if you start another one, it had to come from back at the 18-day average and you're rebuilding. So this bear market rally has run its course. Now, as a chartist going home tonight, you've reinstated the bear market. That's all that I see. Nasdaq is the same picture. Lower highs, lower lows. You closed under the 18-day average. The risk would be to get back over 12,783.75. That would have to be to stop. Target's 11,645. In the Dow, bear market. Lower highs, lower lows. Each one of these markets got up to this number and fell apart. I don't think you're going to argue with me on any of those whatsoever. And by the way, the death cross is looking like it's finally working that we had, as you know, that we've talked about here. No trend in the Russell. It is the one standout. Now, it lost its embedded reading. When you lose an embedded reading, you often go right back to the 18-day average. So I'm looking for this market to get there before it decides what it wants to do next. In the VIX, you still are embedded. If this had lost the embedded, I'd feel so much more comfortable in telling you that was it in the rally. It's over. It's done with. It couldn't lose it tomorrow. And if it does, then I'm going to say that was it. It's over. You're in a new leg to the downside, and I'll be comfortable with that. This as a chartist until the recent highs are taken out again or a new chart pattern develops. In the bond market, what's the point of paying attention? You're sitting here, you're going into the CPI number, and next week you have the Fed coming out with this 50 basis point hike. You're in a bear trend, you're oversold, you're against the support of the Bollinger Band. I think the pros lifting their positions. That's what I'm expecting. I think they did it 3 days ago right here, coming down. Now, if you embed, if you get the blue and the red going sideways for several days in a row, that'll turn me into selling the rallies very aggressively or putting out recommendations for my clients to do so for sure. And I would be wanting to do that, and you can see where you're at on that. In the dollar index, okay, let's assume you rally a bit more. The upper Bollinger Band for resistance is 103.68.5. That's where I think the pros are going to wait for this market, 103.69, right there. That's where I think they'll dump their long positions. This was a nice rally. You're back up from here. You've come up, but you haven't begun anything because you're still in these Bollinger Bands and you're overbought already. No, I'm not looking for a lot of follow-through one way or the other. And the dollar gained on everything today. There isn't a major currency pair that the dollar lost to. I don't care if it was against the yen, Mexican peso, Aussie, New Zealand dollar, Swiss franc, euro, Canada. It didn't matter. It just stepped on everything. Do we have a trend in the euro? No. You lost the embedded reading back here, and you finally got to the 18-day average. How often was I saying that? Night after night here, I think this market's going to retrace. Well, it's done it. In the British pound, you're in the middle of no man's land, trying to be bearish. You've narrowed in the Bollinger Band so much that to get aggressive here, trying to pick up another, not even a full penny, I think it's too difficult. I think the trade's going to wait to see how this all shakes out. Bitcoin still stuck in this narrowness of the Bollinger Band, going apparently nowhere at this point. In the Brent, market popped itself up. You can see how Brent is pulling away from WTI. And when you come here, you still have embedded readings. Until that red line closes under 79, each break is, in my opinion at least, getting bought by the pros. I certainly know what I'm telling my clients, and I'm telling them to buy these markets on the breaks. I can tell you that. Be out if you lose that. And each time it gets to the Bollinger Band, it's a game plan. You're kicking out, holding half your position, kick out, and eventually we'll get stopped out of the market. That's how the bull market ends. When, how, I don't have the slightest idea. But if you don't keep pressing that, you don't get ahead. Gasoline, it's fully embedded. Pull back all you want. You're going higher, in my opinion. 431 right now. 44 was today's high. The upper Bollinger Band's at 443. So there's room if this thing wants to pick up and run, as you can see. And last, the nat gas. Let's understand what's going on. Nat gas was one of these, what the heck's happening? And because it was bullish, it had a reaction. It wasn't embedded. Has the game changed? It has not, my friends. Europe's in as much dire need for that 16% loss of natural gas as before. They can't replace it. They're coming right back. They want the U.S. natural gas. Maybe they throw enough money at that port, they get the thing done sooner than 3 weeks. That's the delay time, they're saying. And then that's going right out of the U.S. market, back into those ships, and away it goes. Has the game changed? No. This is a correction in an overall bull market, and really no more than that. And if you think it is, I think you're on the wrong side of what you're trying to guess. So I'd be very careful. You know, one of the things that we like to do is give you ideas for your trade and how you can work with things, where you put it all together. Well, we've put together our futures trading kit. Now, I had a big hand in every single part of this. I've put 10 chapters together on how you start yourself in trading, and if you're a pro, how you review. There's a tool for every beginner and for you more advanced traders. You have to go back sometimes and check things. What about the cause and effect sheet? I wrote this when Paul Volcker, you heard me, Paul Volcker, was at that point the Fed chair. Why? That's when I was learning M1, M2, M3, money velocity through the economy. This is where you're at today. It's a full circle. You're going to hear every one of these terms. The Fed's going to be talking. Is the money moving in, moving out? How do they take the money out of the economy? You saw what Volcker had to do. What were interest rates at that point? Double digits. So you're back to this. You're not going to double-digit rates now, but you're in the tightening phase. You're not in a Paul Volcker phase, which I'll probably never see in my lifetime again, but if you live in Turkey, you are. If you live in Latin America, you are. Learn what this is. It's so simple, and now you know the Fed speak, the Fed talk, and where these things all go with the Fed. Then, I know a lot of you want to see what we've got here in pivot points. They're included right in this. So it's one area. You get the Arun indicator as well. I've thrown that in. And then chart patterns. I created a PDF of the most popular 14 chart patterns. Print them out, keep them by your chart. Then, a lot of you like the new courses. Well, Bitcoin, all the digital is here. We hook you up with all of them and all the other Merck courses, including the economic events that take place through all that. So how do you get all this? Well, it's so simple. All you need to do is go to www.iraepstein.com. When you're there, go to the word free offers. At any point in time as you're watching this behind me, just take your cursor, move it up. You'll see an icon pop out. Click on it. You'll be right in the free offer area. I'm Ira Epstein. Tomorrow's the big day. I'll see you then.